For decades, the world has been pouring money into the United States, and the United States Treasury bonds have been treated as the safest place on earth to store wealth. But what if that changed? What if one day the countries holding America's debt decided to dump it all at once? As of early 2026, the United States national debt has exploded past $38 trillion, and about 1/4 of that debt is owned by foreign governments. That means the United States isn't just borrowing from investors, it's borrowing from global powers. And if those powers suddenly rushed to sell their holdings, the shockwave would hit every corner of the global economy. The biggest holders read like a list of major economic giants. Japan holds over $1 trillion, China holds hundreds of billions, and Europe, collectively, may control trillions more. That's leverage, and the kind of leverage that can shake global markets to their core. US Treasuries are, at their core, simple IOUs issued by the American government. Whenever the government needs money, it doesn't just print more dollars. Instead, it borrows by selling treasury bills, notes, and long-term bonds. These bonds are the backbone of how the United States funds itself. They pay interest on a predictable schedule, and when they mature, investors get their money back. That reliability is why treasuries are considered the closest thing the world has to a risk-free asset. But their importance goes far beyond America. Treasuries help set the price of money for the entire global economy. Mortgage rates, corporate loans, car payments, even credit card interest, all of them are built on top of US Treasury rates. And for foreign governments, treasuries serve three critical roles. They're a safe place to store foreign exchange reserves. They help stabilize national currencies, and they act as high-quality collateral inside the global banking system. In other words, treasuries aren't just American debt. They're the foundation of modern global finance. Over the past few years, something unusual has been happening. Countries that once relied heavily on US Treasuries are now quietly reducing their holdings, and each of them has a different reason. Japan, America's largest foreign creditor, has already sold more than $220 billion in US debt. Not because of politics, but because Japan is fighting to stabilize the yen. To defend its currency, it needs cash, and the fastest way to raise that cash is to sell treasuries. China, on the other hand, has been cutting its holdings for a very different reason. Trade tensions, geopolitical rivalry, and a long list of economic disputes have pushed Beijing to distance itself from American financial influence. Reducing US debt is part of that strategy. And Europe is beginning to rethink its position as well. With global alliances shifting and geopolitical risks rising, several European governments are questioning whether holding so much American debt is still the safest long-term choice. When international relationships weaken, trust weakens with them. And in the world of finance, trust is everything. As confidence erodes, even the most stable assets, including US Treasuries, start to look less certain. What happens if countries sell too much US debt? If foreign governments begin selling US Treasuries aggressively, the consequences wouldn't unfold slowly. They would hit in waves, each one triggering the next. Here are the 5 major scenarios economists worry about most. A bond market crash. The first shock would hit the treasury market itself. When too many countries sell at the same time, bond prices fall and yields spike. That means the US government suddenly has to pay much higher interest just to borrow money. A rapid surge in yields would shake the foundation of global finance because treasuries are supposed to be the world's safest asset. If the safest asset becomes unstable, everything built on top of it starts to wobble. A sudden stock market panic. Once treasury yields jump, investors panic. Higher yields make borrowing more expensive for companies, which cuts into profits and slows growth. Stock valuations drop fast, not gradually, but sharply, because markets hate uncertainty. A treasury sell-off could trigger a chain reaction: falling confidence, falling stock prices, falling retirement accounts, falling consumer spending. It becomes a feedback loop of fear. A banking crisis. Banks rely heavily on treasuries as collateral. They use them for lending, liquidity, and regulatory requirements. If treasury prices collapse, banks suddenly hold assets worth far less than expected. That creates balance sheet stress. Some banks may struggle to meet obligations. In extreme cases, it could resemble the early stages of the 2008 crisis, not because of bad mortgages this time, but because the safest asset in the system stopped behaving safely. Dollar instability. The US dollar is powerful because the world trusts American debt. If that trust weakens, demand for dollars weakens with it. A large-scale sell-off could push the dollar down, making imports more expensive and fueling inflation inside the United States. And if multiple countries diversify away from the dollar at the same time, the global currency system could shift in unpredictable ways. The dollar doesn't collapse overnight, but it becomes less dominant, less stable, and less automatic as the world's default currency. And finally, geopolitical escalation. Finally, the most dangerous scenario isn't financial, it's political. If countries sell US debt for strategic reasons, not economic ones, it signals a breakdown in trust between major powers. Financial pressure becomes a geopolitical weapon. Economic decisions turn into political statements. And when nations start using money to send messages, tensions rise quickly. A coordinated sell-off could deepen rivalries, harden alliances, and push the world closer to confrontation, not because anyone wants conflict, but because financial instability amplifies every disagreement. In global finance, there is a quiet rule that almost no one says out loud. A rule that explains why countries criticize the United States, why they complain about American debt, but still refuse to dump their treasuries all at once. It's called mutually assured financial destruction. The idea is simple. If any major country tries to sell all its US debt, it wouldn't just hurt America, it would destroy the seller first. Treasuries are so deeply woven into the global financial system that dumping them aggressively would cause the price to collapse. And when the price collapses, the country selling them takes massive losses on its own balance sheet. The more they sell, the more money they lose. It's a trap built into the system, a form of financial deterrence. Everyone is locked together. America, China, Japan, Europe, all tied to the same asset, all dependent on the same stability. If one side pulls too hard, the entire structure shakes. And that's why, despite political tensions, despite rivalry, Despite frustration with US debt, no one dares to push the red button. Because in a world built on treasuries, a financial attack on the United States is also a financial attack on yourself. That is mutually assured financial destruction, the invisible force preventing the global system from tearing itself apart. There is one final element in this story, a tool so powerful, so extreme, that it's rarely discussed openly, but it exists. And every government holding US Treasuries knows it. It's called the International Emergency Economic Powers Act, or IEEPA. Under this law, the President of the United States has the authority to freeze foreign assets inside the American financial system. That includes bank accounts, corporate holdings, and yes, even US Treasuries owned by other countries. In normal times, this power is never used, but if a foreign government were to dump treasuries in a way that looked like a financial attack, the United States could legally respond by locking those assets in place, preventing them from being sold, moved, or liquidated. It's the financial equivalent of a nuclear deterrent, a button no one wants to press, but everyone knows is there. And that's the final reason why a full-scale sell-off is so unlikely. The global system is held together not just by economics, but by a network of constraints, risks, and mutual vulnerabilities. No country wants to trigger a crisis it cannot control. And no one wants to find out what happens when the world's largest economy decides to defend itself. So the button remains untouched, silent, but very real. If you found this explanation valuable, don't forget to like, share, and subscribe to support the channel and help this content reach more viewers around the world. Thank you for watching. Wishing you a warm and peaceful evening. Respectfully, good night.